You just received a significant amount of money. A bonus. An inheritance. Maybe a business sale? 6 figures sits in your account. Your financial future could be transformed by this moment. But one crucial decision stands between you and the market. Do you invest it all right now? Or slowly drip it in over time? This isn't just philosophical. Decades of market data have produced a mathematically clear answer to this age-old debate. Let's define our terms clearly, because confusion here costs money. Lump sum investing means taking your entire $100,000 and investing it in your chosen assets, like an S&P 500 index fund, on a single day. Dollar cost averaging is the systematic opposite. You divide that $100,000 into, say, 12 equal portions, and invest one portion each month for a year. DCA isn't about timing the market perfectly. It's about spreading out your entry points to average the purchase price. Analyst. Now for the data that changes everything. Vanguard conducted a landmark study analyzing returns from 1926 onward. They compared putting $100,000 into the US stock market as a lump sum versus dollar cost, averaging it over 12 months. The results were decisive. Approximately 2/3 of the time, the lump sum approach produced higher returns after 1 year. The average outperformance was significant, often by 3 to 4% in that first critical year, because the money was working in the market longer. Analyst. This leads us to the fundamental principle driving the numbers. Time in the market. The stock market has historically trended upward over long periods. By delaying your investment through DCA, you're statistically more likely to miss out on gains than you are to avoid a catastrophic drop. A JP Morgan asset management analysis found that if you missed just the 10 best trading days in the market over 20 years, your total return could be cut in half. Lump sum investing ensures you're fully exposed to those potential up days from day one. Psychologist. Here's where pure math meets human nature. While lump sum wins on paper, dollar cost averaging wins in psychology. Imagine you invest $100,000 tomorrow, and the market drops 10% next month. The emotional pain, the regret, can be devastating, potentially causing you to sell at a loss. DCA acts as an emotional shock absorber. If the market drops after your first investment, you can tell yourself, "Good, my next purchase cheaper." This behavioral guardrail keeps nervous investors in the game, which is ultimately more important than perfect optimization. Analyst. There are specific conditions where DCA's mathematical case strengthens. In exceptionally volatile, sideways, or declining markets. Think the 2000 dot-com bubble peak or the 2008 financial crisis onset. DCA could have preserved more capital in the short term. It also mitigates sequence of returns risk for someone who absolutely cannot afford an immediate, large loss. However, identifying these periods in real time is famously difficult, even for professionals. For the investor who understands the math, here's the emotion. A hybrid approach offers a strategic middle ground. Invest a substantial portion, say 50% or 70%, as an immediate lump sum. This captures the time in market benefit for the majority of your capital. Then, dollar cost average the remaining portion over 6 to 12 months. This balances mathematical efficiency with psychological comfort, letting you sleep at night while still being predominantly invested. Analyst. We must consider two silent factors: taxes and opportunity cost. If your windfall is sitting in cash earning interest while you DCA, that interest is taxable. Furthermore, Inflation quietly erodes the purchasing power of uninvested cash. The opportunity cost is the return you're giving up by not being fully invested. A 2023 Morningstar study reinforced this, showing that even in high interest rate environments, the long-term expected return of equities typically outweighs the safe, taxable yield from cash holdings during a DCA period. So, what should you do? Let's build a simple decision flowchart. First, ask, is this money for a goal more than 7 to 10 years away? If no, consider safer options altogether. If yes, proceed. Second, ask, would a 20% drop in my portfolio value tomorrow cause me to panic and sell? If yes, choose DCA or the hybrid method to protect your psychology. If you can honestly say no, you have the fortitude to stay the course, then the data overwhelmingly supports going all in with a lump sum investment. The smart money lesson is this. While historical data and mathematical expectation firmly favor lump sum investing, the optimal strategy is the one you won't abandon. A perfectly mathematical plan that you ditch during a downturn is worse than a good plan you stick with for decades. The ultimate wealth building strategy combines an understanding of market history with brutal honesty about your own emotional temperament. Your greatest investment isn't just in the market. It's in building the unshakable investor psychology that lets the power of compounding work for you, uninterrupted, for a lifetime.